Hello traders, Gary Wagner here, just before 10:15 in Honolulu, 4:15 in New York. It is Monday, October 17th, 2016, and this is the Daily Report for Gold and Silver. We do have the precious metals nominally higher today, dollar under a little bit of pressure, off just fractionally. We will try to look at a dollar chart today, but in terms of gold, gold is currently trading, when we look at COMEX, in essence unchanged at 1255.50. As you can see now, we've got a 0-0 print. Now the range extremely tight, 51.10 on the low and 58.20 on the high. So very, very tiny range on the day today. When we look at spot gold, trading up about $4, 1254.62, the low 50.53 and the high 1257.24. So we've got that tight $7 range. Over to silver. Silver trading up about 4 cents, 0.3%, 1743, 1744 in that area. Low 1735 and the high 1749. And for silver, that is a non-existent range, to say the least. And lastly, we'll look at COMEX, up roughly a penny and a half at 1745. Let's take a look at our first chart. So traders, as we've talked about over the last couple of days, there's absolutely no doubt, but I do believe that we're forming some sort of a base in this current area of approximately 1250. It is exactly a 38% retracement of the major rally that occurred this year. Now we're looking at a weekly chart, and the reason for that is I just kind of want to point out the way this market has been moving. And when we consider that really mid-2008, market is trading at around $650 an ounce, and from there it trades up, one of the most phenomenal rallies in history, especially in gold, probably the most phenomenal rally in history in regards to gold. And from there it meandered over 2011, 12, and really up to 13 in this tight range in which we saw lows at around 1564, I believe, and highs at around 1800. And we traded that way all the way through 12, 11, and then as we went into 2013, of course, the market really began to drop, but most importantly, that was the moment it actually broke through this floor at 1564, and from there it meandered slowly for the next really 3 years, from 2013 to 2016. It meandered slowly down to these record lows at 1050. Now 1050 comes in at a 61% retracement. In other words, when we look at the rally and the retracement of that rally, we've got a pretty dynamic move in which we have seen this market really move up and then really retrace, but really hold its ground, find a base or support. And really, if you take a look at this weekly chart and we blow it up, you'll see that the actual congestion or base forming in this market occurred over a long period of time, 1, 2, 3, 4, 5, 6, 7 weeks. So you had really you had almost all of December, beginning of 2016 and January, a couple of months in November, in which we saw this market forming a base. So it did take quite some time. This was a major base to form. But from there, we had this market move up and move up quite eloquently from 1050 up to approximately 1377. Now, with that in mind, we now have a 38% retracement. And so that, to me, actually bodes fairly well. In other words, what we're looking at is the market having one phenomenal rally. And actually on this fib retracement, I've started it at mid-2006 at this dip right here at about 537 up to 1900. The first move down, 61% retracement. We see that right here. From there, we go back into a rally mode. This rally mode here takes us up to 1377, and now we've gotten a 38% retracement. That seems in line with the market after this kind of phenomenal move to the upside, this dramatic downside correction, and now to move back into bullish mode. A 38% retracement is right in alignment with where our models would look for some sort of a retracement to actually conclude. Now, the other thing that we do want to take into account, and it's not something that I brought up recently, and it is something that I think is definitely worth our observation, and that is these year markers. This is that same weekly chart, but what I've simply done is blown it up so that we can look at how gold tends to react at the end of each calendar year, beginning of next, to see if we can find any kind of a pattern in there. And here's what we do find, and that is typically, if you look, here is 2012, so the conclusion of 2011, market comes down and absolutely hits this bottom here. This bottom, of course, trading at around 1520, trades throughout the year. When we look at 2013, again, the market came down towards the end of the year, but in the case of 2013, continued to drop and actually opened at a high and closed at a low on the year. Now, after that, 2014, 15, and 16 are a little bit different in that what we saw is the market was still obviously moving lower, but here we hit the lows of the year in 14, and then we had the market come up mid-year and then come back down. And when we take a look at it, we are looking at about mid-year, market comes down, and in October, we hit this bottom here. And then last year, of course, we hit our bottom in December. So we do have some technical evidence of a market really coming to a bottom or a conclusion towards the end of the year in at least 50% of the instances that we are looking at in terms of a historical seasonal tendency in gold prices. So with that in mind, I draw your attention to our daily chart. As I say, gold currently trading $12.5580, puts it up about 30 cents on the day. Very, very light range. But what's important to me are a series of lows that we'll see and whether or not these lows go into this particular area, because any break below these points, especially 1240, would signal much lower prices because we've broken through, in my opinion, a major level of support right here. However, if the market can maintain and begin to trade at and above this particular price point, I believe we could see this market move back up. At a minimum, I would look for about 1300 is where I think the market could move. It will go back to these series of tops, say anywhere between 1270 and 1300. So traders, obviously, my recommendation is to maintain our current long position in gold and to maintain our current stop. So traders, as far as silver goes, we are sidelined on silver. I'm taking a serious look at it. The question is whether or not it will hold this particular level and will form a base at around 1725. That is a 50% retracement, and it is a retracement from the yearly low that was achieved back in January up to these highs right here that were achieved in June and July. We take it back down, 50% retracement, much deeper than gold. And of course, we're still below this resistance line that I would really want to see a break above before I'd actually venture into a silver trade. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.